Welcome to the summary of our asset allocation group for March that we held on March the 4th. Here are the main points of our discussion this month. Recent US economic data releases led many forecasters to revise US growth for 2024 up again, and forward short rates have moved up further. This prolonged the correction in US rates in February, and taking more duration makes sense now. In our view, current market expectations on the path of interest rates are finally in alignment with the Fed narrative. The macro bifurcation between the US and Eurozone economies is still evident, although we note the moderate improvement in PMI business surveys in Europe. Credit spreads tightened further, but the deluge of investment-grade supply resulted in modest widening at the end of March and early March. High yield continues to outperform investment grade thanks to the additional carry and persistent inflows into the asset class. Hard currency emerging markets have outperformed developed markets year to date amid limited supply. We may see more inflows into the asset class as investors continue to search for carry. Now let's go into more detail. US real GDP is now expected to grow by 2% to 2.5% this year. This means the US economy is running above potential growth, which may have implications for inflation. It is easy to understand why markets have drastically revised their expectations from 6 rate cuts this year starting in March to 3 or 4 cuts starting in July. The Eurozone economy continues to struggle to avoid recession. While February PMI manufacturing numbers were above expectations, most of the improvement came from peripheral countries and the service sector. While Germany is struggling on both counts, France is improving, and the service sector will likely be boosted by the Olympic Games in Paris this summer. Whatever the signals from business surveys, hard data remain weak. For instance, the 0.1% rise in January in retail sales leaves the absolute level well below November, and our base case remains for economic stagnation this quarter. The February CPI number only marginally surprised on the upside, but was enough for markets to push back its expectations for when the ECB will cut rates from April to June. In our view, negotiated wages will not decline as much as the central bank hopes for it to comfortably proceed with a large sequence of rate cuts. The ECB will want to see if wage growth is partially absorbed by profit margin compression. If we keep June as the date for the ECB to start cutting interest rates, we now expect a slower and less linear sequence of adjustments, with 3 cuts of 25 basis points by the end of this year, keeping a final landing rate at 2.25 by mid-2025. Let's look at our fundamentals, technical and valuation scores now. Corporate fundamental scores were partially upgraded due to the solid macro backdrop in the US and low default activity in Europe, which led logically to some upgrade. Credit migration remains negative, but does not change our view of contained default rate rises this year. Technical factors have had the biggest influence on credit markets this year. February again saw significant issuance with $194 billion of new deals, bringing the year-to-date total to $390 billion. March is also expected to see significant primary activity. It was another busy month for new European IG issues, with €83 billion of new supply, bringing the year-to-date total to $150 billion. Half of it has been issued by non-financials. High-yield supply has been less significant, with $28 billion issued in the US market and around €10 billion in Europe. For both markets, activity has been largely driven by refinancings, meaning net supply is absorbable, in contrast with IG markets where net issuance is positive. Credit markets saw significant inflows in February, although there was some evidence of buyer fatigue late in the month, with spreads widening in response. In general, our investment teams see the technical picture as strong and improving for credit markets over the next few months, resulting from a possible moderation in supply after March and continued investor demand for carry. Valuations were tight in the middle of February before spreads then widened, under pressure from the volume of new supply. On average, excess returns were positive in all credit asset classes, with emerging markets outperforming developed markets and Euro outperforming US markets. Most of the weakness in US dollar excess returns was seen in the longer end of the credit curve, with the short and intermediate part of the curve performing well. In terms of credit quality, high yield outperformed investment grade, compressing relative spreads further. In high yield, lower quality credit outperformed, with the CCC segment posting solid performance year to date. In terms of portfolio positioning, our investment team remains neutral to slightly long duration and constructive on credit markets despite expensive valuations. Since 2013, global high-yield credit spreads spend 60% of the time below 480 bips. The same 60% rule applied to global investment grade for spread below 130 bips. The current spread picture is aligned with limited tail risk pricing and the absence of negative catalyst. Although this can change at any moment, spreads can stay in a tight range for a good while. We expect inflows to persist, as all-in yields are probably a relevant metric to assess valuation in the absence of negative catalyst. The search for carry leaves us with similar positioning, with a preference for high yield over IG, an overweight to single B credit in high yield portfolios, exposure to European banks' subordinated bonds, as well as hybrid non-financials and European real estate. After the recent outperformance of the European market, rebalancing in favor of the US makes sense, taking advantage of better pricing at the long end of the IG curve. We maintain our emerging market exposure, but are cognizant of the improving technical backdrop in the asset class. Thank you very much for your attention, and looking forward to speaking to you next month.